All right, so that's officially good morning, everybody. Thanks for being here, being on time. Good to see everybody this morning. What are those things on that side? Oh, that's this one here. Oh, okay. Sorry, I just checking my different cameras to see what's positioned where. All right, notes. All right, that was last week's notes. That's this week's notes. And have you guys love it. Okay, so we have a few people not here yet, so we'll just do a bit of a recap from last week and then we will starting this week's week. Right, so last week we started looking at the last topic in the module 2 of unit 2, which is variable absorption versus variable costing, also known as marginal costing. All right, and what we said is that it is an approach to costing, to decision making, that what it does is when we are doing income statements and these things, it basically treats fixed costs, right? Oh, sorry, who's that now? Oh, Joshua Springer. Okay, cool. Right. Hey, good morning, Joshua. How are you doing today? Good to have you on. All right. Yeah, we now start. Did I miss anything? Right, so under absorption costing, we attach both variable and fixed costs to units of output. And this is something that kind of seemed obvious and seemed like, normal part for the cost. It's like, well, why would we ever do anything else? Would that even be necessary or make sense? And if we kind of cast our minds back to module 1, the tail end of module 1, we met what I like to call the decision-making section of the syllabus of, that module, decision-making accounting. And in it, we saw that there are some costs that are actually irrelevant to the decision-making process. And those costs are, called irrelevant costs. But it's not enough to just call them irrelevant costs. We have to explain why they're irrelevant. And they're irrelevant because they don't actually affect the decision being made. And the question is how? For example, if we consider, let's say, rent, but how could a cost that is part of our cost structure, and on top of which the kind of meta reason we're talking about here is that we're doing cost accounting. We're learning to literally account for costs and attach them to units of output. So what's really, why are we ignoring some of the costs, right? So the reason is because the costs don't differ between alternatives, right? So for example, let's say you booked a trip and you went away and the trip cost, let's say, $5,000 for the round trip, right? And you got to the airport and now you had to decide whether you were going to take a taxi to go to the hotel and then have to take taxis everywhere you go, or rent a car, right? So let's say the cost for renting the car for the period you were there was another $1,000, whatever currency you want, and all costs, they have the same currency. And let's say the cost for taking taxis everywhere was $1,200. So we would just compare the $1,000 to the $1,200. We wouldn't factor in the airfare that we've paid, because we've paid the airfare, we've already taken the trip, we're already there. So whether you add the airfare, so $5,000 was the airfare, whether you added to the $1,000 for renting the car or the $1,200 for taking taxis everywhere, it's still going to come out that the taxi is the more expensive option. But we didn't need to factor in the airfare, right? It's already been spent. So that's why it's called a sunk cost, right? Sorry, 1 second. Yeah. So again, that's why it's called a sunk cost. All right, it's sunk, it's lost, it's gone, it does not differ. It's also called a non-differential cost. It does not differ between alternatives, all right? And, sorry, give me 1 sec. What's going on here now? No? Okay, cool. Huh? Okay, no, I'm just gonna X that off. Yeah, sorry. Got a bit distracted with a little setting on that side. Yeah. So that's why it's called, that's why some costs are irrelevant to the decision-making process, right? And again, those costs are primarily the costs that do not differ between alternatives. And the costs that do differ, the differential costs, those are the costs that are relevant, right? Now, coming back to what we're talking about here. So basically, what we're trying to do is we're trying to compare net incomes, right? The net income made from the end of a process or from a particular decision, et cetera, right? So under absorption costing, as we said, we attach both fixed and variable costs to units. And like I said, that seems logical. It didn't seem like there was another alternative. Like, why would we not attach costs? Again, we're doing cost accounting. We have to cost products properly to make proper decisions, right? Under variable costing, however, we only attach variable costs because we treat fixed costs as as period costs. Right? Even though they are production costs, they were incurred in the manufacturing process, we treat them as a cost for the period, like we would treat insurance, or we would treat like salaries and wages of office workers. We treat it like that. And the reason is because it doesn't differ between the alternatives. It's a fixed cost, right? So we subtract those. Now we do subtract them. It's not that we ignore them in the grand scheme of the income statement. It's just that we don't attach them to the cost of the unit produced, all right? So under absorption costing, when you do attach fixed costs to units of inventory, they end up on the balance sheet, right? It's almost like a prepaid expense, right? You spend this money, but so it's like, if you cast your mind back to like Form 4 when we were talking about income. Well, I don't know how many of you all were with me here in Form 4, even Form 5. But if you buy 2 pens, right? You buy them and the cost price for each pen is $10. So 2 by 10 is 20. So you spend $20. All right, cool. Let's say let's say you sold 1 pen for $15. You're like, all right, cool. And then somebody was like, but wait, you spend $20 and you only make back 15, so you lose money. And you're like, wait, hold on. If I buy 1 pen for $10 and I just sell that pen for 15, didn't I make a profit of $5? And the answer is yes. And the person will be, I spent 20. And he said, yes, I spent $20, but I have this other pen here, which I have not yet sold. And if I haven't yet sold it, then I can't make a profit or a loss on something I have not yet sold, right? So that's why we subtract closing stock. Remember, if you think back to your cost of goods sold section, it's opening stock plus, well, either purchases or cost of production, and then you're minusing closing stock, because you have to. That's why we remember. If you're thinking to like regular adjustments, like accrued and prepaid expenses, right? We add accrued expenses because they were incurred, but they were not paid. And even though they're not paid, we have to include them because they were incurred. That's basic matching principle. And the other one was a prepaid expense. What do we do with a prepaid expense to adjust for it? We subtract it from the corresponding figure in the information above, because we spent the money, but we did not yet incur the expense. So that's basically, you could consider closing stock like that. Hey, I spent this money to buy this stock, but I didn't sell it yet, so it hasn't actually generated any revenue for me. And because of that, I have no revenue against which to match this expense that I've incurred. So it's not just that you're spending money, your cash is going out, cash flow, you have an outward cash flow, and that is the expenses. No, the expenses you incur are the ones you are contractually obligated to pay, right? Not just the ones you have paid, right? Anyhow, I'm going a bit too far down that thing to kind of come back now. So let me just kind of bring myself back, right? So again, and I kind of lost myself. I don't know why I was explaining that before. Anyhow, yeah. So what I was saying is that with the costs on the balance sheet, we send them there because they're basically like prepayments, right? So in any closing stock, it's almost like a prepaid expense, right? You spent money to either buy this thing or to make this thing, and you haven't yet sold it, so there's no revenue against which to match the expense, so you have to store it or inventory it on your balance sheet until you sell it. And when you sell it, then you'll have a revenue against which to match it, right? So I hope I didn't lose anybody there. Okay, so let me kind of bring it back home now. Right, so what we took a look at last week was we took a look at specifically preparing income statements under absorption costing. Now, prior to that, we did look at basically calculating the cost per unit under each of them, variable costing and absorption costing. As you can see, everything is the same except for when we get to fixed factory overhead. Under absorption costing, we include it. Sorry, just gonna have to blink there. Okay, I think it's back up. Right. And under variable costing, we do not. Again, because we treat it as a sunk cost, right? It's irrelevant to decision. So we had a couple other examples where we did stuff like that. Diablo is where I made a little error. Right. And we took a look at the income statement. Now, we did a long version for those who are a bit more conventional and like to see things the way they were, right? So head up normally, name of the entity, name of the financial statement, income statement, and the period to which it applies. You have your sales revenue. We had a little arithmetic to do here. We had no inventory at start in this question, but we added production costs to give cost of goods available, and then you subtracted your ending inventory. Again, you've seen a kind of consistency here, number of units by the cost, right? To find the closing stock, since we produced 10,000 and sold 9,500, we clearly had 500 left. And how we found that 500 was finding the difference between how many units we had at start and how many units we sold, right? Of course, assuming no loss or theft, etc., etc. So you subtracted that as you usually do. You got 38,000 for your cost of sales. You subtracted that from sales revenue. You got gross profit, and then you have your selling and admin down here, right? Now, what we did is we compressed this. So you could compress it in a couple different ways. So one way is you could actually compress just the cost of sales section into a one-liner, right? If you know you sold 9,500 units and they each cost $4, then just multiply 9,500 by 4. It'll save you a lot of time and writing. And in an exam, you kind of want to save time and writing and your brain power, right? And when you subtract that from the sales, you get your gross profit, right? Now, this is my preferred way to do it because it does show the sales revenue. And if you're doing an income statement, you should show it. But again, we are doing cost accounting. And because we're doing cost accounting, managerial accounting, there's no obligation. There's no standing rule that says you have to show certain things. Right? I mean, of course, if you're doing a statement and you're trying to calculate net income and you don't show it, then you haven't completed your objective, right? Now, the other way to compress it is to compress the whole gross profit calculation into a one-liner, right? So you have the number of units, you have the selling price, you have the cost price, you find the difference, which is the gross profit per unit, and then you multiply by the number of units, right? So that was it. So again, you are free to use whichever method you prefer. Now, I'm not saying that these income statements stop here at 47.5. No, I was just showing you how to get to this line more quickly. You still have this stuff down here to do, all right? Okay, cool. All right, nobody waiting to come in. Let me see what's on YouTube. Hey Gabe, what's going on? You're on YouTube today? All right, cool. I don't really watch your comments on that side. Sorry, but yeah, you're almost in the next side. Right, yeah guys, sorry. Just talking to one of my wife's friends, son. Yeah, okay. Right, so we did Milsap and absorption costing income statement. We also did Diablo, and this is the one where I made a bit of an error, right? Sorry. So, yeah. Okay, good, right, yeah, fine. And I think we did Turbo, right? So we did Turbo, we did the cost per unit, and then we did the income statement under absorption costing. So today, we are going to take a look at how to do an income statement under variable costing. And we are also going to notice that, in the majority of cases, right, it's only if you ever have no opening or closing stock that the net incomes will be the same, right? But before I jump the gun and confuse anybody, let me catch myself. Right, okay, cool. So we have that. All right, so we have the information for Turbo. Now I have the Turbo stuff here, but I'm just gonna clear out everything on this page because I want to do it obviously from scratch. I don't like to explain from static things. I mean, I was explaining from static things the whole time, so I mean, I understand the dotations and what I just said. But when I'm doing something new, if it's something you didn't see before, right? Explaining from static images and tables has its place. It's not my favorite thing to be on the receiving or the giving end of, but sometimes you don't have much of a choice. And sometimes it can work, right? If it's for a short period of time. Okay, all right. So what I want to do, let me pull up Turbo's information, right? Turbo. Oh, this one, hold on. Does this one not have Turbo? Yeah, no, I think what happened with this particular file is that it can't do the optical character recognition. So it can't actually go through the file and find words. Okay, so what we're doing now is we're going to do an example of how to do an income statement under variable costing. Now it's going to look a little strange, okay, but it will also look a little familiar. So it's just something. So you have a couple of things. So one, you will know some things that are going to go on. Two, you will not know some things and have to get accustomed to them, and I will endeavor to help you to understand why we're doing it that way, right? Okay, so the following information pertains to Turbo Enterprises for the year ended December 31st, 19X8. All right, so we have variable cost per unit. So we have direct materials, direct labor, factory overhead, and selling and admin. Right, so for the purposes of costing the units, we do not include selling and admin, right, as part of the cost per unit. of the production cost, right? And it's only production cost per unit that is part of the, hold on, let me explain properly. Right, so the value of the inventory that goes on the balance sheet and that even goes in the income statement, it's only production costs, right? So the selling and admin is not attached to the units, except for a specific purpose, and I'll get to that just now, okay? So we have annual fixed costs for factory, selling and admin, and we have other data. So we have sales is 21,000 units, production is 25,000, and that's December 31st x8. Right. Oh, so closing inventory was 11. Okay, so it's, hold on, so opening stock plus production is equal to closing stock plus sales. So 21 and that is 32. Okay, so we had 7,000 units at start. Otherwise, it wouldn't make sense. And I don't know why they didn't tell us that. Right, so, well, this is not a CAPE question. This is a question from my old UE textbook from back in 2000. Okay, cool, yeah. So, yeah, so it resembles a CAPE question in that they don't necessarily give us all the information for every single piece of, well, that we might be accustomed to, because they expect us to read, understand, and know what might be missing and be able to find it, provided we have sufficient information to do so, okay? All right, so what we want to do, we want to be able to, right, okay, so the first thing they wanted was the number of units in beginning inventory. Then they want the cost using variable and absorption costing. And they want an income statement under both methods. Okay, so let's push that up there, push this down here. So we've done some of the work for Turbo already, all right? So let's just recap that real quick. So for Turbo, right, the calculation of cost per unit under variable and absorption costing. So under variable, we just have the, sorry, I was trying to highlight that. Yeah, the direct materials, direct labor, and variable factory overhead. So 6 and 4 is 10, 10 and 9 is 19. Under the absorption costing, hold on, sorry. Give me one sec. I'm gonna just split the page. Yeah, and pull up to where we have, right, annual fixed cost. So we have 600,000. Now, obviously, we're not going to add 600,000 to the $19. So what we have to be able to do as well is take that 600 and find the number of units produced, which we have right here, 25,000. Right. So we're going to take $600,000 and divide by 25,000 units. Right. So that's going to give us $24. So you could see how much of a difference the inclusion or exclusion of the fixed production cost, fixed factory overheads plays, right? It can play a lot, especially if the figure is a lot, right? This 24 was more than the entire variable cost per unit, right? We more than doubled it, right? So 19 by 2 is 38, so now it's at 43. So you might think, well, that's such a big difference. Why would we exclude it if it's going to cause such a problem, right? So again, I'm going to show you, right? So we've done that piece where we've calculated the production cost per unit under variable and absorption costing. We also did the absorption costing income statement. So we did it two ways. We did it the long way, clearly, and we did it the shorter way, right? So we sold 21,000 units, right? Now the selling price is 62. So that's why we have 21,000 by 62. Now under absorption costing, as we just saw, it's $43 per unit. That's the absorption costing, the absorption cost per unit. We sold 21,000, so we do 21,000 by 43, we get 903. The gross profit is the difference between these two, giving us 399, so almost 400,000. Right, and then the selling and admin, so we have the fixed selling and admin, sorry, let me go back up there. Right, that's the 115, and then for the variable, right, so it's $3 per unit, and we sold 21,000 units, right? So 21 by 3 is 63. We add these two, we get 178, and we subtract that from that to get the 221, right? So that's the variable costing income statement. So let me just check in, right? So ladies and gents, just give me a quick G in the chat if you're good so far with the recap and what we have there, right? So now we're going to start taking a look at the variable costing. But if anybody has any questions before we push ahead, right, now is a good time to ask them. Right, so if you're good with that, give me a quick G. If you need me to re-explain any particular aspect, if you have any questions, give me an R and then let me know what your question is. All right. Okay, cool. Thanks very much, everybody. Well, those who answered. All right. So now what we're going to take a look at is how do we prepare. Oh, sorry. This was the longer version as well. Right. So what I'm going to do is I'm going to go on to the next page. I'm actually just going to kind of copy and paste. Hold on. Right. I know what I want to do. Right. So so one sec. Somebody's asking about the PUA past papers. Hey, I have been occupied otherwise, but I have started back producing videos. It's just taking a longer time than usual because now I have 2 kids. So time is at a premium, but I am actively working on them. All right. So if you give me a couple of weeks, I should have the Jan 2024 out, and I'm hoping to have the May 2024 out before March. The Jan 2025, that might be out in the middle of March or so, but it's coming. All right. Sorry for the wait, but yeah, that's just life now, boy. All right. Yeah, guys. So we're talking about the variable cost then. So turbo, all right. So we have the cost on top of it, right? Okay. So what I want to do here is actually I want to split this screen here. Okay, cool. So we're going to replace this absorption thing with variable. Okay. So the selling price per unit did not change. It's the same 21,000 by 62. The cost of sales will now be $19 per unit. Wow, 19,000. Where did that come from? Right. So we have $399. Wasn't that the profit? Gross profit. Oh wow. Okay. Cool. So yeah, now that's not gonna happen every time. Let me just check something real quick. So 60. Okay, so they did. Oh, okay. All right. Yeah. So it just happened that way because of the way the figures were, right? But that's not always gonna happen. All right. All right. And now we have the Sorry, I'm not done. I have to actually kind of clear this out. Yeah. So we don't actually have gross profit. We have something else, right? So I actually have to do a little extra work here, right? So we have to do less variable cost of sales. Okay. So the variable cost of sales is, as the name implies, variable cost. Now, we have 2 sets of variable costs, right? So we have production costs, variable cost, right? So we have how many units? It was 21,000 units at $19 each. Go to, right. And we also have to include, the selling and admin variable costs in this section. Now, I know I just said that we're not going to attach the selling and admin to the cost per unit. And that's not what we're doing here. All right. What we are doing is we are subtracting all our variable costs first to give us something called the contribution, which is this version's analog, or sorry, this income statement's version of gross profit. All right. So selling and admin. One sec. Right. Right. So we have 21,000 at $3 each, right? Sorry. Okay. We're gonna add that together and get 462. We're gonna pull it across, right? And that's the variable cost of sales there. So variable cost of sales. And we're going to subtract that from the sales revenue. This figure is called the contribution. All right. Oh, sorry. No. Right. That's called the contribution. And from it, we have to minus the fixed cost. So let me just actually shift down this a little bit, right? So less, sorry, didn't mean to have the cap still on there. Less fixed costs, right? So now we have what we have. Boy, we have the production, or factory. Yeah, let's say factory overhead. Sorry. So factory, not factory, factory overheads, right? So the factory overheads was 600,000, right? Yeah, factory overheads is annual fixed costs, right? So that was 600,000 for the factory overheads, and the selling and admin, selling clearly. Crap, what was it? 115? Yeah, sorry, 115. Yeah. And we add those together. Oh, hold on, just give me one sec. I keep underestimating how much space I need in the vertical for this one, right? Add those together, pull it across, put that there, right? And that is our variable costing net income, or that's net income. All right, and this one is done. Right, so let me just recap that so you could see, you could just kind of hear me say it again. Maybe if it didn't land the first time, it might land this time, right? So under variable costing, when we're doing the income statement, we take the sales revenue and we subtract the variable cost of sales. Usually we have two sets, production and selling and admin. Now, we are not including selling and admin as part of the cost per unit, but it is a variable cost, which we are subtracting all of first and then subtracting the fixed cost after, right? So again, under variable costing, we'll take the sales revenue, subtract all the variable costs first. That will give us something called contribution, which is this income statement's version of the gross profit. And I'll tell you why it's called contribution, because it's what is contributing to covering our fixed costs, right? So that's why it's called the contribution. So this 840 is contributing or being put towards covering the fixed costs, and then whatever is left over is the net income, right? So this is the decision-making income statement, the variable costing income statement that is used to help analyze decisions, right? Now again, you don't have to put these in caps and align them. I normally like putting them all the way back here, but I feel like because this is a new item, I kind of wanted to stand out a bit more, right? So you are again free to kind of lay it out as you see fit. Oh, right. Okay, cool. Right. So I'm just actually gonna send this in the chat. Give me one sec. All right. And what I will do, I'll check in with you all before. Hold on. Give me one sec. Let's see. Oh wow. Keisha sent me a message since 9:30, and I'm now seeing it. Wow. Okay, cool. Yeah, guys, if you guys send me a WhatsApp and I do respond, it's not because I don't like you, it's because my WhatsApp notifications not coming through all the time, right? Occasionally they're popping up. I tried going into the phone settings, I tried going into WhatsApp settings, I restarted the phone. Everything I didn't do is reset the phone like the factory said, but I feel like going through all that, so it's a problem that I had to solve, and I'm not sure how to solve it. One thing at a time. Right. So, oh wait, I went in to send you a pic and I got distracted. Right. Anybody say finding Dory? Just keep swimming. All right. So okay, cool. So that is your variable costing income statement, right? Now we can do it a longer way where we have like the opening inventory plus the cost of production minus closing inventory. And I normally actually show those. I normally show those larger breakdowns for the absorption costing and side by side, so I could kind of point out the major difference. But I feel like the last couple of years I've been doing that, and that's kind of where things have been falling apart. So I'm a bit hesitant to do it again this year. But before I do any of that, I just want to check in, right? So I'm gonna ask you guys if you guys are good with what I've shown, right? Now I know some of y'all might have seen the school already, some of y'all might not have, right? So when I ask if you're good with what I just did, I'm not asking if you could do it blindfolded. I'm just asking are you okay with what went where and why, right? So if you need me to re-explain this now, so just give me a G if you're good with that right now. What's on the screen? Primarily the income statement, right? If you need me to re-explain, that's not a problem. I will do such, right? I just kind of battling in my brain here with doing the usual thing that I do, right? Which is showing the what you call it, the very long versions of, well, not very long, but the longer versions of each of these income statements to show specifically what is happening, or just giving you the shortcut to it, which is the reconciliation, which we'll get to just now, right? But how I will work it today is I'm actually going to give you guys a couple of questions to try before we talk about anything like reconciliation of the net incomes. Now, what I mean by the reconciliation of the net incomes is if we go back to Turbo Enterprises absorption costing, the netto operating income was 221, and here we're seeing it's 125, right? So that's almost $100,000 less. That's $96,000 less. All right. So you might be wondering, well, how come it's $96,000 less? And there's only one thing that differs between these methods, and it is the treatment of the fixed factory overheads, right? This different treatment of the fixed production overheads is what causes the net incomes to differ, all right? So that there is it, right? Now, of course, what does that mean? Now, if you think about it, right, we just did the variable costing income statement, and we subtracted all of the fixed factory overheads. Under absorption costing, however, we didn't, right? You might be saying, well, Chris, look, we have the $43 here. We including the cost per unit here, and we subtracting it. So how did we not include it? This 43 was calculated using this 24, right? How did we get that 24? We did this calculation here. 600,000 divided by how much? 25. How much? 25,000 units. Okay. So when you come down here and you do 21,000 by 43, is 21,000 equal to 25,000? No, it's not. What's the difference? The difference is 4,000 units. And those 4,000 units have some of the fixed costs attached to them. Now, where are those 4,000 units, you might ask? Well, those are the units that were not sold. And what do we call that batch of units that are not sold? Sorry, that batch that is not sold. Closing stock or inventory at end. And where does inventory at end end up? Well, yeah, you might say, well, it could be in the income statement, but what are we doing with it? We're actually subtracting it. Like I said, you could think of closing inventory almost like a prepaid expense. And we subtract it from the figure in the income statement. And by subtracting it, we are actually removing or excluding it from the calculation, even though it looks like it's part of the calculation, right? It can be a bit confusing, right? But you're subtracting it. So therefore, you're not considering it as part of the cost in the calculation of profit. All right. So where does it end up? It ends up on the balance sheet. So, sorry, one sec. So the 4,000, so the difference, the 21,000 and the 25. So that's number sold, number produced. The difference is the closing inventory. 4,000 by 24. Let's see what that is. If we take 4,000 units and we take 24 and we say, okay, let's multiply those together. Ooh, look what we get, 96,000. And didn't we say the difference between 221 and 125? Let's just put it here to be specific, to be explicit. Ooh, 96, which is equal to 4 by 24, right? So I kind of jumped the gun there, but I wanted to kind of give you a kind of peek behind the curtain before we got there, so that you're not wondering, well, what's the difference? I just going through the motions. No, right? That is why those two things differ, right? It is a treatment of the fixed factory overheads, the attachment of fixed factory overheads to units of inventory under absorption costing, and not doing that under variable or marginal costing, right? Now, the other thing I'll mention here, but I won't go into, is that, so closing inventory plays a part, as does opening inventory, right? So part of me is actually wondering why that calculation worked just now, when I know normally we have, all right, the difference is 4,000, right? So that was the net difference. So again, that's going to cause some more confusion at this point if I go into, sorry. Sorry. I want to get you all to do an income statement on the variable costing before I go more into the explanation. Sorry, my brain kind of did a zort out on me there, right? Okay, so what I want to do is I want to give you, well, clearly not this because this is done and I don't want that. So let's do Milsap. All right. Oh, here's Keisha. All right. Hey, good morning, Keisha. How you doing? Good to have you on. Yeah. Right. So we are doing variable costing today. I just did an example using Turbo. So Turbo was I think the last question we did last week. So we said under variable costing, what we do is the income statement looks a little different than it does under regular absorption costing, right? How it does so is that we don't just have sales minus cost of sales, like we have a sales minus cost of sales. We have sales minus variable cost of sales. And we have usually have two sets of variable costs. We have variable production costs, which the question gives us usually, and we have variable selling and admin. Now the question also gave us that here, right? It told us that this is the variable cost per unit for selling and admin, and it told us that we sold 21,000. So the total variable selling and admin cost was 21,000 by 3, giving us 63. The variable production costs, right? So we have that here. We worked that out already, right? Last week. So we had $19 per unit. And again, if we sold 21,000 units, you multiply that by 19, you get this figure. We add up those two. It gives us the variable cost of sales, which we subtract from our revenue. And we get this thing here, which is called contribution. So this income statement's version of gross profit is referred to as contribution. And it's called the contribution because that figure there is contributing to covering the fixed costs, right? So again, under variable costing, we treat fixed costs like what we call period costs that are incurred in the period, right? So even though these are factory overheads and production costs, we don't treat them as manufacturing or production costs in the income statement. We don't include them as part of the cost of goods sold. We subtract them in total, right? So both the fixed factory overheads and the fixed selling and admin, as you can see here, right? Annual fixed cost, 600,000 for factory overhead and 115,000 for selling and admin, right? We subtract them in total, and then that is subtracted from the 840, and that gives us our variable costing net income, all right? So that's basically what we did so far, apart from a brief recap from last week. Right, so what I was just about to do is give you guys a question to try, right? So I did send in the chat a picture of the variable costing income statement on the screen. So what I'm going to do now is let me just clear out this stuff here and then head up variable costing. And I'll put up the question on the board, on the screen, sorry. Then we'll talk to the question. Variable, right? Okay, so hold on, what's that there? Right, so this is Milsap. Okay, cool. Let's get rid of this. Let's go back to Milsap. Right, so Milsap was on top of here. And let's zoom out a little bit. I feel like that's a lot. Right. Okay, so Milsap Industries began business on Jan 1st of the current year, manufacturing and selling a single product, right? So the thing about having started business in the current year is that there will likely be no opening inventory of finished goods. There is no opening inventory, right? Now, we have production volume 80,000 units, sales volume 72,000 units at a selling price of 20 per unit. Then we have the variable cost per unit. So we have direct materials, direct labor, and variable factory overhead. And we also have variable selling expenses per unit. We then have fixed costs across here, right? So we have the factory overhead and the fixed selling expenses. All right. Okay, cool. Now, what I want you all to do is I want you all to use this information, which I'll put up on the top here, together with, so I'll put back up Turbo Enterprises variable costing income statement, I think. I think that should be fine. Right? You all should be able to see everything, right? Now, again, this is just one of the formats you can use. I feel it's one of the more efficient ones. There are even more efficient than this, where, for example, we could do the 62 minus 19 and 3 and just go straight to contribution. But I think it might be more in your interest to kind of lay it out in a bit more detail, at least for now, to understand how we get to the abbreviated version. Because sometimes when you just do things abbreviated all the time, we don't know how we got there. And it's important to know how you got there. All right. Okay. So, right. So we sold 72 at 20. So that's going to be in your first line. 72 by 1 second. My mom called. Sorry. Hey, mom? Uh-huh. Right. Mm-hmm. Okay. Cool. All right. Cool. So QB out, lock up the front. Okay. Cool. Uh-huh. Okay. Cool. Yeah. Oh, nice. Yeah. Uh, no. Uh-huh. Okay, cool. Yeah. Mm-hmm. Okay, cool. Nah, nah. Yeah. Okay. Yeah. Cool. Okay. Right. Yeah, sorry. Yeah, I have a half brother in from the States for the first time in like 30 years now. And he was here for 2 weeks, he came back tomorrow, so they're just planning a little farewell get together. Anyhow, yeah. So your sales is 72 by 20, right? Your variable cost of sales. So you're gonna total these items here to give you production costs. You have your selling and admin you're gonna show separately. You're gonna do the same kind of multiplication. Right now we sold 72,000 units, so it's 72,000 by what's total here, boy? That's 410. That's at 850. Let's check Milsap. Milsap. Oh, did we do a calculation? Yeah, 850, right? 850 there. Cool. Yeah. Sorry. Right, 850. And you're going to do the 72 by the 0.2, right? You're going to give the figures here, give us subtotal, subtract it from the sales revenue, give us the contribution. And then these two figures here are going to be subtracted in total, all right? Right, so while you all work on that, I just have to go and let the dog out from upstairs before he destroys things. I shall return momentarily. Well, I'm back. Right, and of course, I'll tell you, feel free to send pics of your work, but I mightn't see it because it mightn't pop up, but I'll keep the chat open. Oh, yeah, don't worry. I know the struggle with the internet. Okay. I could give you a couple of minutes again. All right. All right. And then after turbo, what we doing? Okay, cool. All right. Turbo, Milsap, Diablo. All right. So let's go. Right. I'm going to zoom out a little bit about 150. Oh, that's good. Right. So Milsap Industries. Right. Okay. Income statement under variable costing for the year ended 31st December. Okay. They didn't give us a year. Okay. No problem. Right. So we have the sales revenue, or just sales if you prefer. So we sold 72,000 units at 20 each. All right, so that's 72,000 by 20, right? Less the variable cost of sales. All right. Okay, so we have the production costs. All right, so that's 72,000 units again at what we have there, boy. It was 850, right? At 850, 8.50 each. Oh, sorry. And then the selling expenses. So 72,000 units at 20 cents each. 8.5. 14.4, right. We add those two together. Yeah. I have 626,400, and that's the variable cost of sales. And that's going to give me the contribution, right? So contribution. Okay. Right, so let's zoom down. Let's scroll down a little bit and zoom in a bit more. So maybe it might be a bit easier to see, easier on the eyes. Yeah, okay, cool. Hey, Amelia, how you doing? And yours truly. Right, so now we have, that's the fixed costs. No, just copy. All right, so the production cost or the factory overhead. So you could use factory overhead. Oh, hold on, what did I do? Right, production cost is 540, and the selling expenses is just 180 in total. Right. All right, lovely. So let's add those two together. Right, boom. Right, and as the variable costing net income. Right, you don't have to call it that. You could call it net income by itself, operating income, net income, and the variable costing. I mean, if you've headed up your statement and it already says variable costing, then I mean it should kind of be obvious what the item is. You shouldn't have to state it outright. Okay. Let me push that up a little bit. See if I could actually. Right. So that way I have a little more room below here. Okay. Cool. Right, I'm gonna send a picture of this in the chat. So while I'm doing that, if you guys can give me a quick G in the chat, that would be cool. G if you're good. If you need me to re-explain, then by all means give me an R, and then let me know if there's a specific request. Right? So if it's not the whole thing, if it's like one figure or two figures or a particular part of body layout, etc. Oh, okay, right. Yeah, I hope you don't mind me sending the whole screen as opposed to what I normally do, send the question and the solution separately. All right, okay, and then I saw one or two of you all sending some pics. Thank you very much for that, by the way. Right, so part one. Right. Good. And then we have the other piece. Yeah, man. All right, lovely. Good job, well done. Okay, cool. 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 12, or maybe 10. Okay, no problems. So let's do the thing. All right, cool. So that was that particular item there. That is Milsap, right? I think I'm actually gonna just delete those items there because I don't feel like I want them anymore. Right. Let's go back here now. So we did Milsap, we did Turbo. There's a consumer products. Okay, we'll come back to that one. There was Diablo. Okay, so Diablo, we actually have some information for already. So let's just pull back. Okay, actually, you know what? Let me pull that down a little bit more and go into about 150. So it's a little easier to read. Okay, cool. So we had Diablo here. Okay, cool. So Diablo Systems manufactures a specialized video adapter, selling price 79. First year, okay, right. Sales total 40. Okay. Manufacturing, selling, and admin, fixed costs. Okay, cool. Right. So what I want you to do here is I would like you to do, please, the variable hold on, do we have a Diablo? Yeah, we have a Diablo income statement under absorption. All right, cool. So what I'm gonna do, I'm gonna pull this across here as well. That'll be Diablo 2. Diablo 2. All right. No. All right, so maybe just that. Cool. All right, let's put that down. Yeah. Right, so we have Diablo, so we have selling price of 79. So it's the first year of sales, so there's no opening inventory, right? Not that we are showing any of the inventory items in the income statement anyway, right? But we sold 37,000, we produced 40, right? Variable costs per unit are 18 and 22, fixed costs 1.2 million and 207,200 respectively for manufacturing and selling and admin, right? So we already have the absorption costing income statement for Diablo. So what I want you to do for me now is I want you to do, please, the variable costing income statement for Diablo under the layout / format that we just kind of encountered today, right? Okay, so while you're doing that, so I'll let the dog out. I just have to go and fix a couple things because he was kind of being a bad boy. I'll return in about 5 minutes. I guess. Okay, working on Diablo. All right, cool. So I'll give you a couple minutes again. Let me just check and see if anybody said anything picture-wise. Huh. All right. Okay, that looks good. 22, yeah. Right, 37, 37, right. That's it. Right. 40 minus 74. Yeah, okay, wow. All right. So, yeah. All right, let's start starting this one, shall we? One sec. Right, cool. Diablo. Right, and what we'll do, we'll zoom in here. We're going to see the name, and I can actually, maybe I need to put a couple of extra lines. Shift down. Right. All right. Let's zoom in a little bit. Right. Okay. Cool. And actually, we don't want to see all that either. Okay. We want to see some of that. Some of it. Oh, okay. And these notifications actually popped up. So, like I said, sometimes WhatsApp is the notifications working, sometimes they're not. All right. So, and then whole solution. All right. Cool. So sales, we sold 37,000 units at a price of $79 each, right? So that's 37,000 multiplied by 79. Okay. Right. And then we have less variable cost of sales. Sorry, one sec. All right, cool. Okay, so we have manufacturing, because they use that word, so why not? We could use it too, right? So again, we sold 37,000 units, and they gave us that it was $18 per unit, or $18 each. That's 37 by 18. And then we have the selling and admin. So 37,000 units at 22 each. 37,000 by 22, sorry. And so I have 1480, which I'm subtracting from the 2923, and I get 1443. So it's almost even. As in like 1.4 million each side. There's like a little 40,000 differential here. All right. So that's the variable cost of sales, and then the contribution. All right. So with that now, we're gonna minus the fixed cost. Okay, so we have selling, so manufacturing and selling and admin. Right, so we have a straight 1.2 million and 207,200. Right, so almost everything gone there, boy. Wow. So from 1.4 million in gross revenue, we dropped down to 35,800 in net income. Wow, so variable costing net income. Wow. Okay. All right, I'm gonna zoom out and send a pick of the whole thing. So while I'm doing that, if you guys are good with that solution, just kindly give me a quick G in the chat. Right? Now is a good, and if not, give me an R for re-explain. Let me just crop this a little bit, and then I'll check. Right? So I also have a couple solutions to take a look at there. All right, lovely. So 6 out of 12, so half of yours. So the next half, all right, if it is you're having issues, you have to let me know so I could try and help. All right. If it is you're good, then that's cool too. All right. Okay, right. So there was one more question, and on this particular paper, which was not turbo, it was consumer products, right? So this one we could kind of do from scratch, like a kind of whole thing. But I was thinking to show you all the reconciliation statement. But I feel like I want to do this then the rec statement, right? Okay. So here's what we're gonna do. We're gonna do this question first, right? So this question, and I'll tell you specifically how we're gonna go about it, okay? Right. What we have to do in the question, they want the number of units in ending inventory. We'll do that. Then they want the unit cost under both absorption and variable. So we're kind of gonna start with that. All right. So okay, yeah, that. And then we want an income statement under variable costing and an income statement under absorption costing. So we're gonna kind of reverse that order. All right. So let me send a picture of this in the chat. All right. I mean, it's gonna stay up on the screen, but you know, so you guys have a kind of thread in the chat. I know I might be eating up people's storage. I think. Sorry about that. I think that might be one of the reasons my phone gave me trouble. Every time I go to clear it out, it just says apps. I'm like, well, what do I do? I think I deleted or offloaded quite a few apps already, so I'm not sure what else to do. All right, so let's take a quick read, and then we'll do this piece by piece. Right, so the information that follows pertains to consumer products for the year ended December 31st, 19x6. So, right, so at 1/1 is 1st of January, 19x6. We have 24,000 units. Okay, we made 80,000 units. Okay, so just like we did in, remember, process costing, right? We added 24 and 80, and we got 104, and that's the number of units to account for. And then we sold 82. So if we had 104 available and they sold 82, I think there's 22,000 left in ending inventory, right? So we just kind of did that, right? So again, you could apply your process costing section 1, which is the accounting for physical units. You could apply your technique down here as well, right? Okay, now manufacturing costs. So we have direct materials, direct labor, variable factory overhead, $3, $5, and $9 per unit respectively, and a total for fixed factory overhead of $280,000. Right? Now to find the fixed factory overhead per unit, it will be per unit manufactured. And we manufactured 80,000. So you'll divide those two figures, right? Then we have selling and admin, variable cost $2 per unit, fixed cost $136,000 per unit. And the unit selling price is $26, assume that costs have been stable in recent years. Okay, so the first thing I want you to do, so you can write down somewhere that we have 22,000 in ending inventory, right? The first thing I want you to do is I want you to do a calculation of cost per unit, right? Like what I have on the screen here, right? So you're going to do like a kind of side-by-side comparison with variable costs, absorption costs, variable costing, absorption costing. And again, this is only manufacturing. We're not including any selling costs here, right? Right, so materials, labor, overhead, fixed. Okay, so I'm going to give you a couple minutes, so I want you to start there, all right? Calculation of cost per unit, right? And don't forget to note that we have 22,000 in ending inventory, right? 22. Anytime. How you doing? All right. I am going to copy and paste a page. I think I might do this one. This is consumer products, right? Okay. And consumer products was P26, P6. Okay, but I don't have names, right? So, okay, cool. So P26, B6 consumer products, right? So P26-B6 consumer products. All right, so calculation of cost per unit, right? So direct materials is 3. Then we have direct labor is 5. Variable factory overhead is 9. Right, so the fixed factory overhead, we have 280,000. And we made 80,000. We happen to make the same number of units as in the previous questions. So we didn't have to change this. So this will change to 350 per unit. Right. So we have here $17 per unit under variable costing and $20.50 under absorption costing. Right. So can I just get a quick G if you guys are good with that? Right. Those costs there. Please and thanks. All right, cool, lovely. Right? If you need me to re-explain, sorry, give me a R. It's not a problem. Let me know, right? Okay. So the next thing I want you to do is to do the absorption costing income statement, right? So I know we kind of only did variable costing today. So just in case you need a bit of a reminder, the absorption costing income statement, sorry, will look a little bit like this, right? So you have your sales, you have your cost of sales, which will use the absorption costing, right? That gives you the gross profit, and then you have your selling and admin, right? So what I'll do is I'll leave the income statement for this question up on the screen as an example, right? And you can use the information above or and the information we did in the previous part of the question, previous solution, to do the absorption costing income statement, all right?
Chris, you just want the variable statement, income statement?
Absorption cost and income. Well, I want both of them. The absorption costing first, then the variable, right? So, yeah, the one on the screen on the bottom of the screen is a little example of a previous question we did under absorption costing. So we'll do absorption costing for the question we're doing, and then we'll do variable costing after. Hey, Trish, what's up? Hey, Bree, how you doing? Blinking. go back to consumer. Okay, hold on. I'll let the minute finish. Yeah, if ever I'm rushing, you guys let me know, right? I don't want anybody to feel rushed or I didn't have enough time. But of course, I can't give an infinite quantity of time. We don't have that. No one does for anything. Oh yes. Okay. Let's go back to this particular sheet here. I'm gonna have to put that about 50. Yeah. Okay. Cool. So let's do a little separate line, and I don't know why those. Oh, sorry. Hold on one second. Whoa. How did we get all? Right. So let's do this. 10. 10 should be fine. I don't think we need 10. 8.5. 8.5 should be fine. Right. So this is consumer products. Income statement. Absorption costing for the year ended 31 December 19x6, right? You could probably by now use 20x6 because we've had 2006 and 2016 pass, and it won't be long until 2026 has passed. So yeah. Okay, so we're going to start with the sales revenue. Sales revenue. Thank you very much. Right. Sorry. Yeah. Okay. So that was how many units? We sold 82,000 units. Oh, sorry. I'm just going to use that at sign. Oh, sorry. Did I not show the selling price? Yeah, 26, right? 26. Oh, my bad. Did I not show you guys the 26? Oh, I think I would have sent it in chat. All right. 26. Okay. If you didn't see it and it was stuck, sorry. But if that's ever the case, guys, let me know. But then again, my WhatsApp. But then you have here too. So yeah, you could let me know. Oh, I guess 8.5 wasn't enough. Yeah. Okay, cool. There we go. Hold on. Is this centered? They're kind of far from that side. Right. Okay. All right. Cool. Right. So less cost of sales. All right. So we have again 82,000 units at $20.50 each. Okay. All right, fine. Right, so that's the gross profit. The gross profit, right? Less selling and administrative expenses. Okay, cool. All right, so we have variable and fixed, right? All right, so variable. So that's 82,000 units at $2 each. And then we have fixed, which is just 136. That's 300,000 in total, right? Right, so 151. That is our net income and the absorption cost. Okay, so I'm going to zoom out a little bit so you can see the full income statement, right? So if you guys are good with that, just kindly give me a G in the chat. Yeah, Keisha, talk to me. Did I forget something again?
That chart, I do not understand. I only understand it the longer way as a normal income statement.
Okay, cool. All right, so hold on. Are you okay with the cost being $20.50? All right, cool. So if we sold 82,000 units that each cost $20.50, then to find the total cost, we would simply multiply the two, 82,000 by 2050. Now, I'm not mandating you use this format, but I'm just asking, are you okay conceptually with the calculation of the cost of goods sold simply being the number of units sold by the cost per unit? Are you okay conceptually with that?
Yeah.
All right, cool. Now, even if you did it the other way, right? So the opening stock. So give me 1 sec. Let me copy and paste this. I'll do it the longer way, right? Just to make sure that we're honest. But did you get the same value as in 451 for the gross profit?
I was going close and inventory, but I didn't subtract it because when you did the shortcut, I stopped.
Okay, all right. So you want a minute or two to kind of finish it, and then so what you want to do? I copy. Did I copy and paste it? Yeah. Okay. So what I'm gonna do is I'm gonna just kind of shove this down. Oops, that's a little too much. I'm gonna push this down a few lines. So here what to do? Just kind of see if you could finish off by gross profit, then, and I'll see if I could coincide to meet you at the end there. All right. So cost of sales. So we have a opening inventory because we have that. That is the 24,000, right? So that's 24,000 units at, it was 2050. Yeah, 2050. Sorry. All right, so minus 24 to 3 by 20.5. Cool. And then we had to add the production costs. All right, so 20. Well, we made how many? We made 80. We made 80. Right, at units at so minus. Okay, we got to push down a couple more lines again. Right, so this here would be the cost of goods available for sale. Less the closing inventory, which is 80. How much you said? 22? Yeah. Same 20.50. Ha! All right, cool. This 1681. Okay. $451. Huh? We did something wrong. $82 by 26. Okay. No. 16. Yeah, we have same 1681. Okay, so that's interesting. The cost of goods available is exactly equal to the sales revenue, and the closing inventory is exactly equal to the gross profit. Okay, all right. So guys, just so you know, that's, I think that's just how the numbers played things out. That's, hey Sarah, how you doing? Long time no see. Yeah. Yeah, so that's not something that's going to happen every time. So the cost of goods available is not always going to be equal to the sales revenue, and the closing inventory valuation is not always going to be equal to the gross profit. That's not a thing. It was interesting that it happened this time. Okay. All right. Keisha, is this any better? Does this help?
Yes, please.
All right. Cool. All right. Cost of sales, opening inventory, production cost, cost of goods available, closing inventory, cost of goods sold. Okay. I guess I'll indent these two. Right. Okay. Hey, Sarai. Hope you're well. Missing any maths class, girl. Okay, so I'm gonna take a picture of both of the income statement variations, right? So as you can all see, it doesn't make a difference whichever way you do it in terms of the figures. You get the same answers, whether you use the shorter version or the longer version. All right. Okay. So, ladies and gentlemen, if you guys are okay with the absorption costing income statement, I want you all to do now the variable costing income statement, right? Whether you do it the long way or the shorter way, it matters not, right? I'm actually glad that Keisha did it this way because it will actually give me a chance to explain or to include the opening inventory in my explanation. Yeah, so today we'll probably, after we finish this question, I will show you all and give you some notes on the reconciliation process. And sorry, this is too high now. Okay, so you guys working on the variable costing income statement for me, right? I'll give you 5 minutes with that. While you're working on that, let me work on this because I forgot I had to fix this. I don't know what is going on with it. Okay. Oh, no, hold on. I don't necessarily want this. It's weird. Where did it go? Oh, yeah, there you go. Cool. Oh, it's not good. 74. 1 second. So now put on the so what you need time? Oh, sorry, I'd not seen this one. Okay. Yeah, this is good. Oh, it's February. Right. That's me. You think I do like you? It's feel like that sometimes. This topic could get a little accustomed. Could take a little getting accustomed to. All right, careful with the red. Production, that very well. Okay, that looking good. What was the story with the absorption custom? Why I think I don't like you? Let me see if I can help now. Wait, I was doing something. Oh, right. Okay, I mixed so many figures, so a bit more was zero. Oh, okay. Well, I mean, it's still early days. I may need glasses. No, that's a option. That's though I have, I just forget to put them on. I mean, the good thing with devices is you could zoom in. Hannah, I cannot tell you how many times somebody's handed me a piece of paper and I found something to be too small, and I've done this. I've tried to zoom in on a piece of paper by doing the finger gestures. Yeah. So it's about that time. Oh, yes. Okay. Okay. I fix that. Okay, lovely. Um, I'll give you a couple minutes again, and I'll split the screen and organize that. I think if I try to do the reconciliation now, it might be a little too rushed, and I don't want that to be rushed. I think that has been the part that has been a bit misunderstood, the way I've done it before. So, in order to not make a mistake a third year in a row, I will err on the side of caution. Right? We have next week. No, oh yeah, we had a talk about that. So I'll send a poll in the chat. So remember, in Trinidad, it's Carnival Saturday, and of course, the country is abuzz with carnival festivities and these things. I myself, as far as I know, I'm not playing mass or going to any fetes or have any friends coming in that I have to go and visit or whatever the case is. So I will probably 99% sure, 99.9% sure I'll be available for class. Right? I know some of you, the younger crowd, might be going to Feds or Limes or these things. And I won't begrudge you that. I won't speak ill of you or have any hard feelings. I had my days. I enjoyed them. But of course, if you will be here, if you're available for class, I will definitely make myself available as well. We'll of course have to talk to the wife to make sure that nothing pops up, as things have a tendency to do, you know. But such is life, you know. Like my 2-year-old, we woke up. What day he woke up, boy? Wednesday. He seemed to have a very productive eye, as in like he had a lot of cool coming from it, what we call cool or yampy, or what do the Americans call it? A lot of eye crud. I don't know. Anyhow, woke up Thursday morning, put him in the car to go daycare. I was operating in very low light settings, so I don't wake my wife or the soon to be 4-month-old. Got him in the car, and on the way to school, my stepson, and one of his friends are also in the back of the car. And I noticed in the rearview mirror that my son's eyes one eye looked like red and crusty. So I asked him, "What's going on?" They said, "Yeah, looking kind of bad." So I thought that when I carried him to daycare, they'd send him home. But the auntie in the daycare is a former nurse. So she's like, "No, it looked like he just have a draft in his eye or cold in his eye." So they wiped it off and they kept him. I came home, that was Wednesday. No, that was Thursday morning. Sorry, I wrong day. Yeah. So I carried him to the doctor Thursday evening, and they said it was conjunctivitis and it was contagious. I'm like, oh wow. So we didn't send him to school. Well, daycare Friday, kept him home, and he seems to be unbothered by it. Yeah, except that I guess when he wakes up and it was crusty. But this morning it wasn't that way. We got some eye drops, trying to clean it as often as possible. Yeah, so anyhow, but like I said, things crop up. And again, that's one of the other reasons why I have not put out any videos, because things just keep happening. I've recorded 2 this week. This week? Yeah. Started to edit one. The other one I want to do over, because in reviewing it, I was like, nah, I'm not happy with how this come out. So, yeah. So I might do that after class today. Anyhow, I'm talking, I said that thing here. Let me organize this and let's see if we could round it off. Okay. Right. So consumer products, income statement, variable costing for the YAR for the year ended, what was it? Yeah, 31 December 19x6. Okay, so we have sales revenue, right? Sorry, now will be the same 82,000 units at, it was 26, right? 26, yeah. Right, at $26 each. Okay, so equal 82 at 26, right? So less the variable cost of sales. Sorry, one sec. Let's scroll down a little bit so we don't keep things that are unnecessary on the screen and leave less room for what is necessary. Yeah. Production or manufacturing. Let's use manufacturing. Now that's the, whoa. Right, so the variable manufacturing cost was 17, my bad. Right, so we sold 82,000 units at $17 each. All right, so 82,000 at 17, and then the selling and admin. Right, so again, 82,000 units at $2, right? So $2 each. Okay, cool. Add those together, carry it across. So this here is our contribution. Subtract that from 2132, and we're going to get 574. right? Now these things are supposed to look different than the absorption cost, and they're not supposed to be the same. Well, there's, like I said, if there are no opening or closing inventories, or if opening and closing inventories are equal, then the variable and absorption costing income statements will have identical, well, gross profit and contribution and net income. No, sorry, net income, just net income, sorry. Sorry, this is the variable cost of sales, and this is the contribution down here. Less fixed cost now. Right, and we have factory overhead and selling and admin, right? So factory overhead and selling and admin. Right, so the factory overhead is 280. Selling and admin is 136. Sorry. 416, and then 416 from 574 will give us, what's that? 158. Yep, there you go. Lovely. So that's the net variable costing net income. Right, let's maximize that. Right, so if you guys are good with that, just kindly give me a G in the chat. If you need me to re-explain anything, it's not a problem. Yeah, Keisha, talk to me. What's up?
And the absorption cost, and we do opening stock. What we didn't do it in the variable cost.
Right, okay, so there is a method, there is a way to do it. Let me just send a picture in the chat of this, and I'll see if I could run it up real quick for you, right? Because there is a parallel way to do it. So I want, if that's something with which you are more accustomed, I don't want to deprive you of that. So just give me a couple seconds here just to send this real quick. Right, okay, so what I'm gonna do, right, can I pull this? I'm gonna pull this. Right, so I'm gonna actually copy this, put that here, and I'm gonna copy this. Okay, so this is the kind of more traditional way that we would, that can be used to do the variable cost income statement, right? So 82 by 26 is that. Now, opening inventory is that. Now, the cost per unit under variable costing is 17, right? So we're going to use that here. All right, so minus 24 by 17. We're going to change this to 17 as well. Right, cost of goods available for sale, and then 22 by 17 again.
Where's that one is 82 to production cost?
Oh, 82 here? Yes, no, manufactured.
Oh.
Yeah. Yeah, the opening inventory was 24 and we manufactured 80, right? So 24 and 80 would give us the 104, and then we sold 82. We sold 82, and we have 22,000 left. Right. So this is the variable. All right. So that's the variable production cost. See, 1394. All right, and then we could do just copy and paste that whole thing. $158, yeah, right. So variable cost of sales. Yeah, okay, so this is the other way you could do it with the conventional opening inventory plus production costs, giving us cost of goods available, and then subtracting the closing inventory to get variable production cost of sales, and then variable. No. Right. And this, right. Right. And we add these two to get the 1558, which again ties back to the same 1558 we had on top of here. Right. 574 is the contribution. The fixed costs, that was unaffected by the choice of presentation above. Right. Okay. All right. Keisha, does this work a little better for you? All right, cool. No problems. That's fine. That's fine. All right. Okay. Right. So, folks, we are at 12, right? So, unfortunately, I won't be able to do the reconciliation today. But like I said, I think it's better because I think I would have been rushed down. And I do want to explain it. I will try to prep that before I just jump into it Saturday so I don't mess it up like the last couple of times. But it's I promise it's not hard. I went overboard. That was what happened, right? All right, okay, but folks, that's about it for today, right? So I hope that today was productive for you, that you understood. Of course, if you have any questions you didn't get to ask during the course of class, please feel free to message me. Again, my WhatsApp giving some troubles. If I don't get back to you one time, it's because I haven't sorted that issue out yet. I had to find someone to help with that. Anyhow, and yeah, that's about it for today. And have a good weekend, and I'll see you next week. Bye.
Bye, sir.
All right, guys, later. Bye-bye.